Hey everyone, welcome back to Corporate Decoder, the place where we decode corporate filing so you don't have to. Today we are looking at a Form 8K filing from Sow Good Inc. and boy is the name ironic. I mean, Sow Good. It sounds like a health food brand trying to make the world a better place, but the details in this report tell a different story. In this report, Sow Good tells us about how it's dealing with some debt. In short, they are swapping old debt for new debt. This usually happens when a company can't pay back the old debt right now. They aren't getting extra money to invest, just pushing the problem further down the road. So on April 28, 2025, Sow Good made a deal to exchange $2.7 million worth of old promissory notes. Think of them as IOUs for new ones. These old notes had different maturity dates, meaning the dates they needed to be paid back, ranging from April to August of 2025, and different interest rates from 6% to 8%. Instead of paying off the old notes, Sow Good created new notes worth $2.8 million, the $2.7 million from the old debt plus some extra for unpaid interest. These new notes are called senior convertible promissory notes, a fancy term, but here is what it means. Senior means these notes get paid back before other debts if Sow Good goes bankrupt. Convertible means the people who hold these notes can turn them into shares of Sow Good stock later on. Promissory means it's still a promise to pay them later on. Promissory means it's still a promise to pay. The important thing is that the new notes don't have to be paid back until April 30, 2030. That gives Sow Good 5 more years to figure things out. Interest on the new notes will be paid twice a year in May and November, starting in November of 2025. Here is something interesting. Sow Good gets to choose if it pays the interest in cash or just adds it to the total amount owed. If they add it to the total, they don't have to pay the interest right now, but they will owe more money in the long run. It's like saying, I can't pay you the $10 now, so I'll owe you $11 later. Those who hold the new notes can convert them into common stock, and that will be based on a price between 62 and 63 cents per share. So these note holders could become big shareholders in the future if they want to. These new notes are senior, meaning they get paid back before any other debt the company has now or takes on later. This is good news for the note holders, but it could make it harder for Sow Good to borrow money in the future because other lenders will be behind these note holders in line to get paid. Sow Good can pay off these notes early if they want to, but starting January 1, 2025, the note holders can also force Sow Good to buy them back for the original amount plus interest. This gives the note holders some power. The people on Sow Good's board of directors and audit committee who don't have a personal stake in this deal all approved it. This is meant to show that the deal was fair and in the best interest of the company, not just a few people. For all the nitty-gritty details, you can check out the actual form of the new notes that Sow Good filed as an exhibit. Now let's step back and look at the big picture. Sow Good is in a situation where they couldn't pay off their old debts, so they had to make a deal to push the payments further into the future. This isn't necessarily a sign of strength. It indicates they are struggling with cash flow. They are having trouble paying their bills. The good news maybe is that they bought themselves some time. They have 5 more years to turn things around and start making enough money to pay off these debts. The bad news is that they are kicking the can down the road, and the can is getting bigger because of the added interest. One major risk here is if Sow Good can't improve their financial situation, they might have to do this again in 5 years. Or worse, they might not be able to find anyone willing to lend them money at all. One potential opportunity is that Sow Good could turn things around. Maybe they will come up with a new product that sells really well, or find a way to cut costs and become more profitable. If that happens, they could pay off these debts and be in a much stronger position. In conclusion, Sow Good's decision to exchange old debt for new debt is a sign of financial stress. It buys them time, but it also increases their long-term risk. Whether this was a good move or not depends on whether they can use this time to improve their business. Right now, it looks like they are not in a very good position. I definitely wouldn't say Sow Good. Thanks for watching. If you found this helpful, please like, subscribe, and leave a comment below. What do you think of Sow Good's situation? Let me know in the comments.